In this lesson, we're going to talk about engineering of liquidity. But first, let's talk about every unprofitable trader's favorite word, manipulation. So first, let me clarify. Manipulation absolutely does happen in the markets. I'm not saying it doesn't exist, but normally I only hear this from coping traders who have got stopped out on a trade or lost, and they're using manipulation as an excuse for why they had a bad trade or why a trade went against them. I have had the benefit of speaking to and observing tens of thousands of traders. And as such, I've observed that those who feel that the market is manipulated tend to think that it goes against them. You're only human, guys. Whether you're 15, 25, 35, all of your life, literally 99% of your life, of your existence, you've been taught that the word manipulation is a bad thing. Not even talking about markets here, I'm talking about life. The programming of Clown World makes you think that manipulation is a bad thing. So instead of calling it manipulation, it's better to frame it in terms that make it more applicable to the markets and also avoid you from any subconscious negative biases that you may find. Okay? So instead, we're going to look at it differently and we're going to use it to be on the right side of the trade. So here we have the actual meaning of what we call manipulation, which is a spring or a failed breakout or a sweep. What in reality is happening? All that is happening is engineering of liquidity by smart money. And what they do, in this example, we have accumulation. In accumulation, large traders create an extremely weak environment. Real accumulation shouldn't feel to you like a great time to accumulate. It should feel like it's going lower. It should feel bad. It should feel choppy. It should feel like shit. How does this get created by the smart money? Well, they maximize FUD, fear, uncertainty, and doubt. This is when you see all the bad news coming out. This is when you see everybody bearish on Twitter or YouTube or TikTok. FUD is maximized. And then the smart money make price action match that. It's violent. It's choppy. It moves in unexpected ways. These are all in attempts to make as many dumb money people as possible enter on the wrong side of the market. Because you need to understand how accumulation or distribution works. If you think of it this way, through engineering of liquidity, you will be much better placed. Let's say you understand what accumulation is, yeah? People buy at low prices so then it can go higher. But how does somebody actually buy? How does smart money actually buy? If we were all smart and we all knew it was accumulation, we would all buy. So then who would sell? It wouldn't be possible. It wouldn't be possible to accumulate unless somebody was willing to sell it to you. Understand? And so there are so many different tactics and schemes and tricks that the smart money will use, all in the attempt to make the dumb money sell to them so that they can buy. In the case of this accumulation. And the same is true of a top. Whenever they want to exit their positions, they will have all the good news in the world, everything that makes the price seem like it's just going to keep going up, it's bullish, it's bullish, it's bullish, so that people keep buying dumb money so that the smart money can sell. So we've talked a lot about Wyckoff theory, and we have in this what's known as a spring. This blue box, this pushing below a low, that is a spring in Wyckoff theory. I also call it a sweep personally, so you'll see me talk about it as a sweep a lot, and the technical term for it is a failed breakout. And this happens in a number of ways. There are multiple causes to this. The effect of which, if you remember those two words, cause and effect, multiple causes to this, the effect of which is a successful accumulation that eventually goes higher. So we're going to talk about three causes that are on the sell side, meaning they fill the buy orders of the whales, and one cause that's on the buy side, which is where the whales actually use their own buying and selling to support the market. So those causes are, number one, stop losses. Number two, breakout traders. Number three, boredom or lack of interest. And number four, profit taking. So let's talk about them each one at a time. This is why I call it engineering liquidity, because big players create an environment that has a high probability liquidity area. One misconception that is very important to note at this point is when we have this, what we come to call a spring, failed breakout, or sweep, nobody knows for certain that this is going to work like this. There's always a chance that it ends up being a breakout to the downside. It's not guaranteed. Even the smart money can't guarantee where the market's going to go. That's important to note because a lot of times new traders think these all-seeing, all-knowing whales, they just get the market right all the time. It's not true. Bitcoin especially is actually mostly traded by big players, institutions, whales, large players, hedge funds. The amount of retail trading is actually very small. In reality, it's not that big. So the engineering of liquidity is a process that is not guaranteed to work. And that is why I talk about them sending it to a high probability liquidity area. That just means there is likely to be the type of liquidity they want. And it's, 80%, 90% likely, but it's never 100%. And so what do? They hold price in a tight range with a clear support level because this will attract longs with stops below there. So this is the first cause, stop losses. You put price in a range, tight range, going sideways. You have a clear support level, as this black horizontal line marks. And then all throughout this, on each of these pumps, traders, dumb money, will go long and put their stop loss below the line. That's the first way. So then, when the smart money pushes price down into that, what does that create? Stop losses are a sell order, and that sell order has to be matched with a buy order. So the smart money gets buys filled at a low price. Great. First one achieved. Second one, breakout traders. When the low gets broken, this horizontal line, when that low gets broken, we know for certain some people are going to short it because that's a valid trading strategy. Breakout trading is one of the most common types of trading. It doesn't always work, but if you do it correctly and you understand how to breakout trade, eventually everything does break out. You understand? Eventually the move has to make a new trend. So breakout trading is always present. So how does that help the smart money accumulate? Well, this will attract breakout traders. It will attract fresh shorts, sell orders, which is more liquidity for the smart money to buy. And then the third way is actually, it's all throughout this range, but mostly after this bounce back into range. Bounces back in with a nice volatile move, but it then goes into a very low volatility, quite disinteresting, choppy, messy period. That is to make people give up, which is the third cause, boredom or lack of interest. Boredom and lack of interest are found all along here, especially in these parts, where it gets particularly choppy and messy. People who actually were long will exit early. They will take profit or they will cut their losses. Here, after a bounce back at the range, some people will have FOMO'd in. They will have gone long here, and then it drops back, but it doesn't seem like it's moving. They're like, oh, price looks messy, it looks choppy. They sell. The more of those people that sell is the final way for those smart money to get filled. And the fourth part is a way that smart money very cleverly engineer their own liquidity to ensure a higher probability of success with their accumulation campaign. What does that mean? You have to remember, the smart money are getting short here, short here, short here, short here. Each of these bounces, they're shorting them. And then they're taking profit probably at the lows each time, but they're leaving some shorts open. And what happens when they finally push it down beneath? They also have some shorts in profit. So they take profit on their own trades. By taking profit on their own trades, what do they have to do? They have to buy. You close a short with a buy order. So their own buying at this point then supports the market once it's below the low, which is very important because it helps price break back into range. And as it breaks back into range, those breakout shorters, the ones who shorted the down, they get squeezed and they get force buying because to close a short, you have to buy. And so their stop losses get hit or their liquidations get hit and it pushes price up. And so the whale, the smart money, is able to take profit on his own shorts, help the market support, push it back inside, and then we move on to the final part where we bleed people out through the lack of interest. So why is this all so effective? It's so effective because it creates both forced and voluntary selling. Forced selling through stop losses, voluntary selling through breakout traders. It also creates voluntary selling through boredom and lack of interest. People don't feel like they want to sell, but they still do. They're like, oh, the market's going nowhere. It's really, really good. It's super effective. The profit taking, like I mentioned, it helps avoid a proper breakout, which the smart money don't want. And the return to range offers bullish momentum as the shorts get squeezed. As we go back into range after the successful spring or sweep, the stop losses are getting hit of those breakout shorters. And that offers some bullish momentum and completes the final part of the accumulation sweep phase before we move into the consolidation and eventually go higher. So that's it. Super effective. In reality, quite simple. You now know it's not manipulation. It's not out to get you. It's liquidity engineering. Very, very common and vital for markets. It has to be done. Big players need big money and they need it filled. So finally, to say for the top, the exact same thing happens just in reverse. It is no different. Flip it around 180, look at the chart the opposite way, and it's the exact same. You push it above a high instead of sending it below a low. You have stop losses of the shorts instead of the longs. You have breakout traders who are going long instead of short. You have the same boredom and lack of interest from people who don't think it's going up anymore or going down. And you have profit taking. Profit taking in the form of shorts, sell orders. The longs are putting in a short order, a sell order, to get out of their position and take profit. So that's it. That's your reframing of manipulation. I want you to see it differently now. And I want you to understand that it's not a bad thing. And done correctly, it can make you a lot of money in the markets.